All right, Rajiv Bamra, nice to be here. I oversee the global strategy and operations for the Digital Economy Group, and a major portion of my work includes bridging the gap between what we do in the traditional world and how do those credit fundamentals get impacted the moment you start digitalizing the assets, the issuances, or the issuers getting exploited or exposed to the investments they're making in the crypto asset world. So looking forward to the discussion.
Good morning. I'm Nikos Andrikogiannopoulos. I'm the founder and CEO of Metrika. We are the leading risk management company in digital assets. We provide a real-time risk platform where we monitor all of the risks associated with the asset itself. We provide that to qualified custodians. A lot of the GSIBs in the space are customers, tokenized asset managers. We provide the credit rating agencies with key risk indicators, and a number of other financial institutions and crypto natives on managing their risk and compliance. I'm very excited. I think the topic of trust and the topic of risk management and security needs to become more core as we think about institutional adoption. So I'm really happy to be here.
Good morning, everyone. My name is Shadi Hussain. I lead the digital asset security strategy at JP Morgan Chase.
Ryan Rugg, Global Head of Digital Assets for Citi's TTS business. Been at the organization for about 3 years now. We launched last year Citi Token Service, so happy to share about that, but have been in and around this space for a decade. I see some colleagues in the audience where, prior to this, I was at IBM, where I ran their blockchain practice for Americas, and then prior to that, worked for a fintech startup called R3 for 5 years. So looking forward to this conversation.
All right, awesome. Well, I know there's many familiar faces in the room, and I think as we were preparing for the panel discussion today, we got into a relatively back and forth discussion in terms of just the inherent risk profile associated with crypto as an asset class. And I know we had some diverging perspectives there. So Nikos, I'm wondering if you can kind of start off and share your perspective as it relates to whether or not there's an evolution around crypto and inherent risk within the business, which will set the stage for kind of diving into frameworks and discussion.
Yeah, I think the misconception, I think, in the space is that same activity, same risks, same assets, same risks. But if you look back in history, when you look at equities and you think about equity risk, if you wrap that equity inside an ETF and then you look at the risk of that ETF containing those equities and the treasury, it's a complete different risk profile than looking at kind of equity risk. So the same thing with tokenization. If you tokenize a bond, if you tokenize equity, if you tokenize other assets, then when you look at that profile, now you're using a new financial market infrastructure, which is blockchain, and there are different characteristics of that, whether it's public, permission, what kind of protocol, what level of maturity, security, and a number of other factors. And then you look at kind of governance, and you look at operational risks, and you look at how third-party risk in the whole kind of process around that. So I think fundamentally you can argue that this risk profile of the tokenized asset or of crypto itself is completely different than what we're used to and we've looked at in the past. We recently wrote a paper with Chartist Research, and we talked about that the risk is very different in its composition. There is a lot of operational, technology risk, bigger proportions of that risk in those tokenized assets than there were before. So.
And I know that there is a diverging view, Shadi. Maybe you can jump in.
Yeah, sure. So I do believe that there is significant change in the underlying correlation between the risk domain, but I do think that the discipline of risk management remains the same and remains sound. We do have to understand that, yes, there is changes in the infrastructure layer. There is ability for assets to move across jurisdiction just with a line of code. And that has changed how things operate. However, I strongly believe that the discipline of risk management remains the same. However, the transfer function between the domains, the market risk, the liquidity risk, and the cybersecurity risk, right, are converging to some extent. But the systems and functions below the system remains the same.
Can I turn it into a fight?
A friendly one.
I would argue, I think you're absolutely right. I think what fundamentally changes here is that when you have a tokenized asset, now you can use it as collateral in a smart contract, in a lending pool. It can move the speed that the collateral can move, that can get used in other DeFi services, has never been seen before in finance. So when you think about the risk and compliance function, how it is operationally structured, how the tools that people have, the processes that they have, there is a gap between the efficiency that the blockchain provides and the higher yield. And the question is, you get that higher yield, but what's the risk associated with that? What tools, processes do you have in place to manage that at the same speed, at the real-time speed, and at the composability that you are seeing on the blockchain side? I think this is not a question that is being asked sufficiently. And I think part of the issue is that when you look at emerging risk teams at financial institutions, there is so much that they have to do. There is AI risk, there is digital asset risk, there is ESG risk from the past, all of those emerging risks. So now they need completely new tools, completely new processes to adapt to that speed.
Maybe just to add a real time, like a real story behind this. So when I was at IBM, Nit and I were advising an exchange that had taken in $35 billion that year. The exchange is no longer here. And they wanted us to rewrite, it was an RFP, they wanted us to kind of rebuild their core banking system because it wasn't real time and couldn't monitor the proper risks of blockchain efficiently. We're like, all right, walk us through what you have. And they pulled up Google Sheets. They were measuring their risk on Google Sheets. So, needless to say, unfortunately, they went out of business. But there are exchanges that are still in business that we had 500 employees on that were doing transaction due diligence monitoring. I can tell you right now at Citi, if I had one backlog, I would lose my job. So it's a very different way that these organizations measure risk. And as regulation is kind of coming into fold and these parameters are being set, I view that, it's going to have that shift where, safety and soundness and consumer protection is really important in this industry. And you're going to see that kind of migrate over time.
I was planning to play the referee between Chadi and Nico, but I think Ryan covered it well. So I agree. I mean, what digital finance is doing or tokenization as a technology is doing, it's not taking away the risks. It's actually reshaping the credit fundamentals. And the question to ask is, do the operational and the technology risks now start playing a role in the credit and counterparty risk portfolio of the assets that investors want to invest in and still get the same kind of protection at the end of the day? Do the tokens carry the same legal rights as their underlying collateral? And there is a lot of work that is happening and still needs to be done and may take a lot of time in order to have a single source of truth, which is not the case today. Because if there was a dispute, what record do you strongly rely on, or what record do you trust? Is it the traditional book of records, or is it the distributed ledger? A lot of things are still sitting on distributed ledgers because on-chain, off-chain reconciliation is still a very common step. It's the point is that the best practices now need to be integrated into the assets or the compliance of those assets and the chains as well. And that's the work that needs to be done at scale, which hasn't happened.
Yeah, I mean, that's the root of many of the popular conversations in the equity tokenization space in particular, at least over the last 4 months, with different players in the market taking different approaches, touching on those different topics. I'm interested, and everyone was alluding towards this in terms of existing institutional risk management frameworks. And I think on kind of the JPMC side, the Citi side, and Moody's as well, and then Nico's from the perspective of actually serving them, how are you seeing, if at all, those frameworks evolve? Or are you really looking at the integration of these risks within existing frameworks and maybe lower level shift of inherent risk between categories?
I'm happy to start with Citi Token Service. So with Citi Token Service, we fully embedded it into all our KYC, AML, sanction, all the TradFi checks and balances. Otherwise, we would have never gotten approval to kind of go forward. So I think that that's important. And we are in a private permission chain, so all the clients are traditionally onboarded, but we are moving large sums of liquidity around the globe. So I think that, over time that may migrate and change slightly, the way that networks look and the way that we monitor, because the nature of this is you can't have quarterly or annually audits. You have to have real time because the nature of this technology is 24/7. So I think that And we also need a lot of regulatory clarity in regards to, what's going to happen with the market structure bill, and our token's going to be viewed, similar to how money's viewed, where money comes into a large institution, we do the KYC, AML, BSA, all the TradFi checks and balances. Well, now, because of a token, you can see where it was 5, 10, 15 hops ago. And if it was in a sanctioned country, even though we did the KYC on a client coming in, what does that mean for large institutions? So I think that we still need some clarity from market structure.
I just wanted to add Moody's ratings perspective on that question in terms of frameworks, right? Because we have decades old or centuries old frameworks and methodologies which have been refined over time. We've seen a lot of ups and downs in the market in that period. How we are viewing this, and this is based on the kind of formal and informal voice of the customers when we talk to our stakeholders internally and externally, is there are mixed messages. One, some investors want to keep the credit aspects of the asset separate from the technology and operational aspects of that asset in the tokenized world. And some want that integrated. So there is that lack of standardization, which currently requires to be looked at independently and in a silo, and then find ways or have integration points where you are kind of integrating the technology operational layers, minting, burning, on-chain settlements, on-chain coupon payments. Our legacy systems are not made for that. So now you have this operational layer which can be independently evaluated and then have integration points into the credit fundamentals of this asset when they scale, because the idea of a token wrapper around a traditional asset or the underlying collateral changes the very fundamental of that asset. And it's not really clear, there's not even a regulatory clarity as to how they would look at these two assets differently, and that's really what is needed. There are regulations and frameworks, but until there is clarity, we need to start, as a risk assessment firm, we need to start looking at these risks anyway for our issuers, and then try to find integration points as the market matures and there is more clarity in the ecosystem between institutions and the regulators.
I just want to say that while I still believe, again, that the discipline of risk management remains sound, the definitions remains the same, I totally agree that the underlying risk profiles are included in some context, and basically the systems needs to change. With that, we do see that change happening with the frameworks that we currently use. Look at Basel. They currently include on-chain stress test in the models. Look at NIST CSF. They included validators, best practices, custody module, and policy engines as well. Look at FAIR. It also includes a probability distribution of on-chain events. So I think the industry is evolving in the right directions, and all the frameworks are currently being upgraded to what's happening with the digital asset space, but there is a lot of work still that we currently have to do.
From our perspective, we're privileged to see some of the risk frameworks of the largest GSIBs and financial institutions and work with them. Typically, there is a journey on financial institutions where they start with an existing risk framework, which is typically an Excel spreadsheet. And they work either with us or with consulting firms at the very beginning of their journey to translate that into digital asset risk. And once they do that, I think there is the issue that it still remains the output, the deliverable is an Excel spreadsheet. So now they're thinking, how do we operationalize this? Now we're operating in a blockchain environment with smart contracts, with assets, with composability and other smart contracts. So they're trying to find a risk platform like ours to kind of operationalize that. And then I think they're coming to the second realization, which is the types of risks that they were measuring before were either qualitative in nature, they would require a risk analyst to opinionate on which level this risk is, or they would be missing some other risks that are quantifiable but were a little bit outside kind of the scope of what they had done with the consulting firm. So most often you need to adapt that risk framework to something that is real-time, quantifiable, and requires less qualitative judgment and kind of human risk analyst type of thing. I think that's the one challenge. But now, if you think about this problem expanding, once you do custody, at some point you need to do staking, particularly with crypto. So now you have a staking risk framework, and you have to monitor all of that. If you tokenize your assets, at some point you want to use them in a DeFi protocol, and you have DeFi risk that you're taking on. So this process needs to repeat again and again until your risk frameworks are operationalizable, real time, and you have the safety and soundness that you would want as in traditional finance.
I don't know that Rajiv was intending to lay a pun, but we have progress as it relates to Clarity. Hopefully in the next couple of weeks, we'll hear more feedback there. Material changes in risk frameworks and best practices that are now being updated for topics related to on-chain participation, staking, and other topics that are relevant here. And maybe we go down the line to the left as we're wrapping, what are the two things we have to get right as an industry in order to build trust and really facilitate this next wave of institutional adoption, both in the context of permission networks as well as permissionless public networks?
I think probably everybody would agree that the common theme that all of us shared, irrespective of which side we are on, and if you want to make it a fight, is everything. We are seeing market convergence, right? We are seeing these long tail assets like private markets actually trying to tokenize their assets to liquidify them and provide access to retail investors. We are seeing data-driven sustainable finance, where the AI analytics is using ESG data and then that is being tokenized. We are then seeing at a global scale emerging markets trying to actually build the infrastructure from scratch because they can, and their systems are not as integrated and interoperable as developed countries. And all of this digital data will need data centers at the end of the day, which is going back to the private market space because that's where private equity comes in. And all of this is going to amplify the cyber risk perspective. So this complex risk that we are talking about needs to be addressed, and the frameworks need to move from Excel models to a more digital real-time monitoring and surveillance ecosystem, including by regulators who need to look at on-chain assets as well as the off-chain compliant factors and then try to do that in real time as well. So there's a lot of work to be done in terms of infrastructure development.
I would just say two things. Education, I think, is important, and it's being mentioned today, particularly on the risk domain. And the second thing is I would urge risk officers to be involved earlier in the process. Typically, there is the pattern of a POC where the risk officer is not involved, and then when things move into production, then they need to take that journey. So I think the earlier, the better.
Yeah, I think when money or code becomes money, I believe the most important thing is a security-first mindset. The culture of your developers needs to change. They're not building any Java application anymore. We're talking about the regulated financial product itself. It's what they're building. That smart contract that represent that asset on chain. That's the most important thing. So for the developers themselves, your engineering team needs to understand that a small mistake can have big consequences. Security first mindset with everything else that we can talk about, which is like shift left and zero trust deployment infrastructure and all those things. I think that's the most important aspect.
And I think I'd add safety and soundness. As enterprises start to enter this space, they don't want additional operational risk. They don't want to open additional accounts. They don't want to have to manage keys. They don't want to host nodes. They want a trusted partner to be able to do that. And I think that it's been key, part of our adoption process is we completely obfuscate the complexity of a blockchain for our clients, where we manage all the keys, we do all the work for them, because meeting enterprises where they are in their journey. Do I think in the future they'll have wallets and host nodes? Yes, but that's not the reality of where our clients, especially our large enterprises, are now. And if you think about their treasury management or ERP systems that they've had integrated for numerous amount of years, being able to manage that risk it's difficult. So I think the more that we can take on, as well as others up here can start obfuscating that risk until clients start getting used to the real-time nature, 24/7, the atomic settlement, the DVP, all that because there is, as Nikos mentioned, a lot of additional risk. Like you have a 24/7 internal network as well as external that's always on. You can't have weekly, monthly, annual, monitoring. You need real time. And these nature of these wallets and the public nature of it. So I think there's a lot of considerations, but I think for like day one, that safety and soundness and assuming helping our clients get that is really important. I feel like as an industry as a whole, we can't have another crypto winter, right? I feel like we've had so many of them out there due to different risk issues, and some of them were related to digital assets. Some of them actually were just poor risk management, right? Like that absolutely had nothing to do with the industry, but it sets us back every time as a whole, every time that happens. And folks like myself, as others on the stage, have to start the whole education process all over again, explaining this technology and how it's different, and the immutability of it, and the programmability of it, and the importance of it, because people get caught up in the illicit behavior and all that, where actually the true impact of what this can do is having that 24/7, 365 network that's always on, right? Where money matches the speed of internet. So I think it'll take time, but we're starting to see that change.
Awesome. Well, I would say in the prep call, we diverged slightly, and in listening to the group speak today, I would say we converged on a topic around the risk side, but really in the spirit of how do we elevate and build trust in the industry. So I want to say thank you to everyone for joining us today. Give them a round of applause, and we'll shift forward.
Thank you.